what are some of the biggest mistakes that you see people make when they start businesses? All right, what's up, Path to Freedom listeners? Very excited to bring Michel Reeder onto the show. Michel is a CPA. He's with Swartz and Reeder Advisors. Michel and I have gotten to know each other a little bit over the years, and he's been a trusted advisor to me and a lot of the people that I've worked with that have gone on to invest in franchise businesses. And I'm very excited to have Michel come on the show today because he's going to have answers to questions that I know anyone out there that's considering getting into business for themselves has had, will have, etc. So, Michel, welcome. Thanks so much for dropping in here on the Path to Freedom podcast.
Wes, brother, it's a pleasure to be here. Thank you for having me, man. I've been looking forward to it. Now we're finally doing it.
I know. We're both pretty busy, right? So we've had a couple of scheduling issues. I think most of them have been on my end, but here we are. We're finally getting this recorded, so ready to bring it to the masses. But hey, man, for those listening that aren't familiar with you, just give us kind of a quick introduction and a little bit more about what you do, what your firm does, and who you work with.
Absolutely. So to all of you Path to Freedom audience out there, it's a pleasure to meet you. My name is Michel Reeder. I am a CPA. I'm an entrepreneurial CPA. I own a business called Swartz and Reeder Advisors, and we're a CPA firm physically located in the greater Chicago area. But what we really are is a virtual CPA firm. We were becoming more and more of a virtual CPA firm before COVID. And then when COVID came, we pretty much just tripled down on becoming a virtual CPA firm. Even all of my Chicago clients would prefer to do a Zoom compared to going in person, and so virtual that I have another property now here in Portland, Maine. So I'm coming to you live from Portland, Maine, and we have a niche as a CPA firm in the franchise industry and working with business buyers. So I have a nationwide network of franchise professionals that refer me their franchise buying candidates. And my process involves providing complimentary consultation to these prospective buyers to answer any questions they have in the context of accounting, tax, entity structure, funding, financial projections, resale, financial statement due diligence if it's a resale, items 7, 19, and 21 of the FDD as it pertains to their prospective business purchase. And several of these buyers, after having the consultation calls with me, become clients of my CPA firm. So I have several small business franchisee clients as my CPA firm clients all across the country. I now own the CPA firm that hired me out of college. My mentor, Barry Swartz, he took me under his wing. He showed me the ropes. And I became a partner in 2015, and I bought him out outright in 2019. Barry's still here working full time because he loves what he does, and he doesn't know what he would do with himself if he didn't have to work. But I love what I do. I'm a business owner myself. And I'm the advisor to hundreds of other business owners. I'm talking to buyers, talking to existing business owners, existing clients all day, every day, throughout the year. And I absolutely love it. There's never a dull moment. So that's who I am professionally. And that's what I'm up to in the world. I'm married. My wife and I, we have a little girl. She's 1 year old. And when I'm not working, which is not often, I'm working all the time, but it's gratifying because I'm working for myself. I'm a big Chicago Bulls fan, and I'm a big Chicago White Sox fan. So basketball and baseball. I'm a big Bears fan too, but they've been really, crappy recently. So, but
yeah, it's been tough to root for the Bears for a while. So I love it. And thanks for all the background info and the detail. And so couple things I want to unpack there, right? I mean, first is I think it's very important, the fact that you're a business owner yourself, because all of your clients are business owners. So, you've got a lot of insight into, what business owners are dealing with, what some of the challenges are because you're a business owner yourself. how do you feel about that? I mean, do you feel, it gives you a big advantage in terms of being able to add value to your clients, the fact that you're a business owner as well?
Absolutely. Absolutely, Wes. And it does, because I know exactly what they're going through. Yeah. And nothing against, accountants and CPAs out there that, that are on the payroll of a firm that they're not an owner of. Nothing against anyone. But it carries a lot of weight when you're a business owner advising business owners. And we're going to get into this and throughout the whole episode. Accounting and taxes and tax planning is the foundation of my professional relationship with my clients. But the value that I provide them goes so much deeper than just accounting and taxes and bookkeeping. It's the advice that I provide. It's just the overall advisory, the consulting as a business, as a trusted advisor and a business strategist that I bring to the table beyond just simple, and not simple, but accounting and tax. It goes way beyond that. It goes much deeper. And so much of that is because I drink, eat, and breathe being a business owner all day, every day myself. I'm living it. Yeah,
no, I agree. I think it's important. And so that brings me to my next question, right? Because you mentioned, your firm that you now own kind of has a niche in franchising, right? A lot of your clients are franchise business owners. So, what difference does that make, right? And I'll give you an example, right? I own 2 different franchise businesses currently. We have a CPA that we've worked with the entire time we've owned businesses. I would not say, neither would he, that he is a franchise expert. He has maybe a handful of other clients that also own franchise businesses, but that's not a niche of his. What advantage do you have being an expert in franchising that would put you in a better position to add value to someone that owns franchise businesses or is looking to own franchise businesses? Because I believe there is definitely value. Like, I know I've had to kind of explain some things to my CPA in terms of, why things are a certain way in a franchise business versus a business that we own independently.
Yeah, absolutely. It's a great question, Wes. So first of all, with buyers, my familiarity with the franchise disclosure document and the items within it are things that, a lot of financial professionals out there, whether they're CPAs, financial advisors, the FDD is a big, lengthy document, often more than 200 pages. It's a cure for insomnia. But there are certain items in there that are, that are financial related, that, as a franchise attorney should, always work with a buyer when they're redlining the franchise agreement. And there's a difference between the FDD and the franchise agreement. The franchise agreement is the actual document that is the contract. But, there are certain items in the franchise disclosure document that are financial and number related. And I'm very familiar with them. So working with prospective buyers and targeting in on the item 7, that shows the low and the high end of the investment, of the initial investment, and the different pieces of it. The item 19, right, which are financial statistics of existing franchisees in the system, and that's discretionary, meaning that the item 19 could be very robust and it can have lots of data, lots of revenue samples of like the top performing franchisees, the bottom, the middle, et cetera, or the franchisor can decide to include nothing, or it can be somewhere in the middle. Mm-hmm. And then item 21, the audited financial statements of the franchisor, and what are they telling the reader of the FDD. So very familiar with the financial aspects of the franchise disclosure document. That's for buyers, right? Proper treatment of a franchise fee for income tax purposes. Now, oftentimes here I'm the bearer of bad news because you'll get and I have clients that are on all sides of like the tax position spectrum, right? Like clients that want to be ultra aggressive, ultra conservative, somewhere in the middle. And, you know, and in accounting and taxes, and I'm sure we'll unpack this as part of the whole dialogue, Wes, you know, they're like, what's black, what's white, and what's gray, right? There's really not much that you can do in the black and white. And then in the gray, like, what can we do, you know, while optimizing the tax position, while not raising any red flags, like what's left for interpretation, et cetera. But a franchise fee is black and white. It's what's known as a Section 197 intangible asset, and it needs to get capitalized as an asset on the balance sheet and amortized over 180 months or 15 years. And so, you know, to my aggressive client that just pays like a $50,000 franchise fee and they want to write off that $50,000 like in the year, you know, they're not really happy with me when I tell them that. But a franchise fee is a Section 197 intangible asset. And even if the life of the territory is like, you know, 5 or 7 years and they're going to have to renew it, it's still for tax purposes, it's amortized over 15 years. Yeah. And any unamortized amount with some sort of exit event, whether there's a sale or a disposition of the business, the unamortized amount would be part of the basis of the assets that are disposed of at the time, thus decreasing any capital gain or increasing any capital loss upon sale. So the familiarity with FDD is a big niche that I know a lot about compared to other accountants out there that are not niche and franchise like I am. You know, just I'm seeing franchise fees all the time with my clients. So just to know proper treatment of a franchise fee compared to just an ordinary expense that you can just write off through expense. And so a big one here is my familiarity with the Rob C Corp. The Rob C Corp is very niche to the franchise world and the business resale world. And so I am very well versed in the Rob C Corp for my clients that go that route. Not even just my clients that go that route, for the buyers that I'm talking to that are debating, you know, that the biggest thing that we talk about, Wes, on the consultation calls that I have with buyers are entity structure strategy and funding strategy. And so those two topics are attached at the hip. And so, you know, hey, Mike, do I go Rob C Corp? Do I go LLC? Do I go S Corp? And let me pause right there to everyone listening. What is a Rob C Corp? So ROBS is an acronym for rollover as business startup. Okay. And so what it is it's a way for business for people to use their retirement assets to fund their business and to use it for their business operations. And so it's got its pros and cons, just like everything else in business and life. And so what I bring awareness to are I consider, you know, the Rob C Corp along with the other entity structures with clients when they're going through this process of determining how to fund their business. And so what it involves is you have to structure as a C corporation, and the C corporation gets its own retirement plan. And the retirement plan of the C corporation is the majority shareholder of the C corporation. And if the owner wants, and then, you know, depending on how it's structured, you can pay out salary there. You can pay dividends that majority go to the retirement plan. But there are certain tax implications when you're a C corp compared to another common entity like an LLC or an S corporation. There are fees that are associated with the C Corp ROBs that need to be, you know, brought awareness to. And then exit strategy needs to be discussed. How do you get out of it? Like, how do you exit from it? How do you convert it from a C to an S? Everything. So very familiar with the Rob C. There are many CPAs that have never heard of it before, and ones that do have a limited understanding. I know a very strong familiarity with the Rob C Corp. So those are things off the top, like on the surface, that, you know, differentiate me from other CPAs when it comes to franchising.
Yeah, those are great examples. And I was one of those clients, like you mentioned, when I first found out that, oh, you mean we're not going to be able to write off these franchise fees for the year that we paid them in? And so, you know, I share with a lot of people that I'm working with. I'm like, no, when you pay a franchise fee, that's actually an asset that sits on your balance sheet. Some people seem pleasantly surprised by that. Other people seem surprised, but not in a pleasant way, because they want the write-off. And all of these are great examples, right? Where another CPA that's not, you know, as versed in franchising just may not have as much familiarity with these things and may not be in a position to advise in the same way that you could. And it's interesting that you brought up the two most common topics that you talk about on, initial consultations with someone is funding strategies and entity setups, because those are obviously questions I get all the time as I'm working with people. And, I've got a basic understanding of these things, right? And the pros and cons of different approaches. But, it's why I love having someone like you that I can connect people I'm working with, because, you're going to give them a lot more of a detailed understanding than I'm able to. But so one of the questions I was going to ask you was, outside of someone doing a rollover, the ROBs that you mentioned, because with the ROBs, you are required to set up a C Corp, right? There's not an option to have another business entity. And to your point, there are pros and cons in doing that. I've had some people opt not to do a ROBs because they did not want to have to operate under a C Corp. I've had others say, hey, look, I much rather prefer to tap into these retirement funds and not get hit with any tax penalties. And I'm okay with the structure of a C Corp. But what are your thoughts? So outside of a C Corp, if someone's doing a rollover, is there a particular business entity that you feel is better suited for franchise ownership, or is it really just on a case-by-case basis, for the individual, where they are and what they're looking to do?
The latter, Wes, you hit it on the head. Like case by case, it cannot be any truer because everyone's situation is different. When I'm having that conversation, when I'm having those consultation calls with buyers, talking about entity structure, strategy, and funding strategy, I'm always getting context on three different buckets, right? Bucket one, what's the investment, right? Initial plus the first 6 to 12 months. Bucket number one. Bucket number two, what is the allocation of assets on the personal financial statement? Like cash, non-qualified accounts like brokerage accounts, and qualified retirement accounts like 401ks, 403bs, IRAs, et cetera, TSPs. And then real estate, primary, second home, vacation home, investment properties, and then any other, cash value of life insurance. Like what are the different assets? Okay. That's bucket two. Bucket three, what's the household income and expense situation? All right. Is the prospective buyer going to keep their corporate job and invest in the business that's a manager run model or a semi-absentee? Are they going to quit their job, or have they been laid off recently? And this is going to be an owner operator thing. And then spouse, do they have a spouse? Number one, if they do, does the spouse work? Does he or she work, or does he or she not work? And then, is there rental income, so then that, and then also what is their monthly cost of living? And so bucket number three, household income and expenses, those three buckets, right? Investment, personal financial statement assets, and household income and expenses are all attached at the hip. And all three of them together, I get on, a piece of paper and then I have all of the facts in front of me, and those facts are unique to every different buyer that I talk to. And so what I talk to, I may talk to buyer number one, and a ROBS makes a heck of a lot of sense for them. I may talk to buyer number two, and, ROBS may not make much sense, for them compared to like an LLC or an S Corp. For buyer number three, they may be a great candidate for an SBA, whether they do the SBA loan through the C Corp ROBS or through an LLC. Buyer number four may not qualify for SBA because they're, they may be over liquid, like their liquidity may exceed the investment. I know that COVID, the SBA scaled back on that a little bit, but then, is it an emerging brand? If it's an emerging brand, SBA may require more post-closing liquidity compared to, more of a legacy brand. If they have a bunch of equity in their house, what about a home equity line of credit? If it's a smaller, if it's a smaller situation, what about setting up an LLC with a 401k plan, adding a participant loan, and then doing a 401k participant loan? You can borrow the lesser of $50,000 or 50% of plan assets. So you can be your own bank for up to $50,000 on a 401k participant loan. And that's not a ROBS, that's the 401k participant loan. So that's another way to leverage retirement assets without doing ROBS. How much do they have in their stock portfolio? They may qualify for a securities-backed line of credit.
Yep.
How much cash do they have? I was talking to this one buyer the other day, and her husband are real estate professionals, ultra successful. They have, like their net worth is 17 million, and they've got like 5 million sitting in cash. And they've got so much cash that their financial institution will just give them a line of credit on their cash. Like, that's great, And so
that's great. But the way inflation's going right now, they may not get that offer for much longer. They ought to just stroke a check if they're looking for a franchise, put that money to work instead of, but no, I mean, it's the answer I thought you would give. Right. And you did a very good job of explaining why. The answer is it depends, right? It really depends on, the individual or the individuals that are starting the business. Where are they? What is the investment of the business? What's their income situation going to look like as they start the business? Once you have all that information, then you're in a position to say, hey, here are the options that would be available, right? And in some cases, there may only be one option. And in other cases, there may be multiple options, right? Like if you, through working with someone and they realize that, yes, the rollover for business startup is the best option for me, well, then the only option they have for their business entity is the C Corp, right? But you may lay it out for someone else and say, look, you could do an S Corp, you could do an LLC. Here are the pros and cons of both. And then it's really up for them to decide. And I think that's the way it should be, right? I mean, it's the exact same as, when I get on the phone with someone, they're like, Wes, what's the hottest franchise out there? And I'm like, that's an impossible question to answer. It depends, right? And there's all these things that we have to unpack and that I have to learn about someone before I'm in a position or even qualified to say, hey, here are some franchise businesses that I think could be a good fit for you.
I got to ask you, Wes, how many times are you asked each year, hey, Wes, I want to own a Chick-fil-A?
Yeah. Man, if I had like $5 for every time I've been asked that question, I'd be doing pretty well. I may, be able to close down one of my franchise businesses or something, right. But, and I've pretty much just stopped trying to explain to people that Chick-fil-A is not in fact a franchise. It opens a whole can of worms unless it's like, unless I really need to go there with someone, I just kind of gloss over it. Because it's amazing how many people think that if they wanted to, they could go out and buy a Chick-fil-A franchise, which we know is not the case.
Yeah.
That's a common one for sure. Hey, another question I had for you, because I'm actually looking at doing this with one of our businesses that is currently an LLC. We're looking at converting it to an S Corp. How common would you say it is that, it could make sense for someone to start a business under one entity structure, but over time and as the business grows, it may make better sense to actually convert to a different business entity?
Yeah, great question. So what I love about the LLC structure, one of the great pros of the LLC structure is that it's a hybrid entity for tax purposes, which means that an LLC with one owner is known as a single member LLC. Mm-hmm. And by default, a single member LLC is taxed as a sole proprietorship by default. By default, an LLC with two or more owners is taxed as a partnership. So an LLC default with one owner taxed as a sole prop, two or more owners taxed as a partnership. But at any point in time, if not initially, later on, the LLC can elect to be taxed as an S corporation or a C corporation. And, being taxed as a C corporation for the most part, like unless you're a Rob's, it doesn't make sense.
Right.
But it makes a lot of sense to be taxed as an S corporation. And so it's still when you make that S corp election for an LLC down the road, it's still an LLC for all intents and purposes, except that it's taxed as an S corporation instead of being taxed as either a partnership or a sole prop, which is what it's being taxed pre-election. And so S corporation tax benefits are all about self-employment taxes.
Right.
Self-employment tax is a terminology for, it's another way of saying Social Security and Medicare taxes.
Yep.
It's 15.3% of net business income if you're a sole prop or if you're a partnership, and if you're taking payroll, then it's essentially 15.3%. And so what that 15.3%, it's not income tax. Okay. It's a separate tax. And so of that 15.3%, 12.4% of it represents Social Security tax and 2.9% represents Medicare tax. And there's a cap on the Social Security piece. So every taxpayer out there, their first $147,000 of earned income, whether it's W-2 or it's active partnership income or active sole prop income, it's capped out. I believe in 2022 to adjust each year. I believe for 2022, it's $147,000.
Okay. So
147,000 is where the Social Security tax caps out at. So then after that, everything over and above, it's more 2.9% instead of the full 15.3. So the tax benefit of being taxed as an S corporation instead of a partnership or sole prop is when the saving, because when you're taxed as an S corporation, you take a salary for a piece of your profit, and you pay the self-employment taxes on the salary piece, but the remaining S corp profit, while it's still subject to income tax, it's not subject to self-employment tax. So just in a very simple example, you have $100,000 on a sole proprietorship or a partnership, you're paying income tax on 100,000 plus 15.3%. So that's 15,300 in self-employment tax right there. And if you're S corp in that situation, you take 40 or 50,000 as salary and the other 50 or 60,000 as S corp distribution. You're saving 15.3% on $50,000 or $60,000. So you can be saving, $7,000 or $8,000 just in self-employment taxes alone by being taxed as an S corporation compared to a sole prop or a partnership. So that's the main tax savings in S corporation versus sole proprietorship or partnership, which is what an LLC is by default, is self-employment taxes, not to be confused with income taxes, but it can still be a substantial tax savings. And it only makes sense to do it if you're making money. If you're not making money, then there's no benefit.
That's why it doesn't make sense to do it probably year one. Right. Or at least as you're starting the business, it's like you said, once you get to the point where the business is, really making some good income. So thank you for walking us through that. Cause this is fairly common, I feel like. And like I said, we're going through this process and in our businesses currently. One of the things I've been told by our CPA is, when you elect to get taxed as an S corp, you have to pay yourself a salary. You have to pay yourself a reasonable salary. Is this one of these gray areas that you were referencing earlier? So let's say, I don't know. I know it's probably tough for you to say, right? But let's say my business nets $300,000 a year. Is it reasonable to say, hey, we have a $50,000 salary. And so that the extra $250,000 in profit, whether that's paid out through distributions or bonuses or whatever, would not be subject to that self-employment tax. Is the IRS going to look at that and be like, nope, no way, that's not reasonable? Or would that not raise any red flags?
There's a lot to unpack here, so I'm glad you brought this up. So, this is where it's about being tactical. So this is definitely gray area. The reasonable salary of an S corp shareholder who's materially involved in the business is the epitome of gray area. Okay. Yeah. And so the first thing that I would say in this situation, I would say, okay, all right. So the business nets 300,000 before owner's compensation. So with that being said, is this a solopreneur where it's like a real estate agent that the only thing that real estate, like that S corp, the only thing that S corp is doing is where the real estate agent is reporting their commissions through it. And if that person were to just decide to go to Hawaii for 6 weeks, then no one's selling or buying houses. No one's working. That business only operates when that solopreneur is working it. So that's one scenario. Or is it a scenario where it's a business that has employees, that has a layer of, there's the owners, and the owner spends his or her time, maybe 10 to 20 to 30 hours a week, but then there's also a layer of management and there's a layer of employees. And so if it's, I would imagine your business, Wes, is more of the latter. It's not a solopreneur. It's a business that you own and you have a manager or managers or employee and
Correct.
employee. Is that fair to say?
Yes, we could go to Hawaii and the business is gonna keep running. Income will keep coming in. So yeah, it's more of the latter and what we're looking at, for ourselves in terms of taxing like an S corp.
Right, absolutely.
Yeah.
Because ultimately, an S corporation who's a shareholder who's materially involved in the business wears two hats. Okay, they wear a shareholder hat. So as a shareholder, they want to get a return on their investment in the form of profit distributions, but they also wear an employee hat. And they need to get paid, a reasonable salary that reflects, their time working the business as an employee. And so in that first example of the real estate agent, so like where it's a solopreneur situation like that, I think the reasonable test is around, 50% of net income before owner salary has to go to salary. Because it's tough to justify taking less, but obviously you want to find we need to talk about retirement plan too, because that adds a whole different layer. But in the situation that's more in alignment with yours, if you can go to Hawaii for can you go on vacation for 6 weeks and is the business still operating? Then in my professional opinion as a CPA, that gives you justification to give a salary lower than 50% of net profit before owner salary. And so then that's where then the reasonableness now goes to, okay, now in this situation, let's say that, it's 300,000. Okay. And we're talking about, okay, do we go 50,000 W2, 250,000 K1 profit? And so I would say, all right, in this situation, you've got managers, you've got employees that are running the business when you're not there. If you were to go out into the market and hire, and like what you do in like the 10 to 20 hours a week that you're working the business, would you be able, like if you were to go out and like hire someone off the street and train them and have them do what you do in those 10 to 20 hours, what would you pay them? And say, I think I would pay them 50,000, then in my opinion, I think that 50,000 is reasonable.
Yeah. Makes sense. Yeah,
So
there's a lot of gray area, and it all comes down to a case by case basis, right? And that's why it's important, right? Because this is one of the other things I wanted to ask you, but it's important that because I think a lot of people are like, hey, do you work with a CPA? They're like, well, yeah, I have someone that does my taxes every year. Well, it's like, okay, well, I've learned there's a big difference between having a CPA that you work with and having someone that does your taxes every year. Like if you have a good CPA and if you're being proactive and working with them, you're strategizing, right? You're looking at what's coming up. You're looking at the future and you're having these types of conversations to say, hey, how can we take advantage of every tax incentive that we possibly can as business owners, and what do we need to put in place? What do we not have in place that we could? So, I mean, and that's something like we were not good with this when we first started owning businesses, and we're really trying to get better at it, is being more proactive and working strategically with our CPA, because it's one of the big reasons many people, it's one of the things that's attractive about business ownership, right? Is there are a lot of tax benefits, tax incentives for owning your own business. If your CPA is guiding you the right way, you're not doing anything illegal, you're taking advantage of incentives that the government's put in place because they want to incentivize people to go out and start businesses. But, I'm curious, what are two questions for you? And again, we've already established so much of this is, on a case by case basis, right? But as broadly as you can, first question is, what are some of the biggest mistakes that you see people make when they start businesses? Like from a, entity structure standpoint, from a, tax standpoint, not having themselves set up appropriately, assume they start a business and they really have not proactively consulted with a good CPA. What are some of the most common mistakes that you see? And so like, if you start working with someone that's a couple years into their business, what are some of the things that you have to come in and usually help them clean up?
Yeah, absolutely. Great question there. And this goes, I'm going to go into, I'm going to demonstrate here how I'm more to my clients than just the tax guy, right?
Yeah.
Like, the tax guy and the bookkeeper, because but starting there, the biggest mistake that I see so many small business owners make, and I have empathy for them because I get it, because small business owners are wearing multiple hats.
Yeah.
They're working, crazy hours. It's gratifying because it's for themselves. But then, they want to spend, when it comes time, they want to spend time with family, like everyone's, after a long day, you want to relax, spend time with family, weekends, totally get it. But one of the biggest problems that I see in like the tax accounting realm of it all, because there's so much more to business, by the way, as you know, there's so much more to business than just accounting and taxes. It's a key pillar, right? Like the financial, like the CFO hat is like a key pillar. Clients not taking their bookkeeping seriously.
Yeah.
There's so many small business owners. Bookkeeping is this thing that needs to get done because they got to file taxes. And it becomes it's always like this fire drill without a bucket each year around tax time to get like the 12 months of bank statements, punched up into the QuickBooks and send it over to the accountant so they can prepare the taxes, only to do the same thing next year.
I've been there. Yep.
And so have I as a bit. I mean, I'm an accountant, and I've been doing this for 11, 12 years now, but in those early years, I'm no, I had and that's why I've been here, lived it just like your audience. And so, having a set of books, regardless of your industry, regardless how big your business is, solopreneur, a master franchisee, anywhere in between, your books are the foundation, an accurate set of books. So getting your accounting system, set up, getting your accounting internal control, like strong and functioning from day one is so foundational, because you can't have, as a business owner, you can't have any substantive conversation in the context of, okay, tax planning is number one. Okay. Tax planning, huge. Okay. But forget about tax planning, like put tax planning over here. What about, a CFO related conversation that's focused more on cash flow and profitability? Like taxes is part of that, right? But like overall cash flow and profitability. And so you can't have any sort of advisory conversation in the context of tax planning, cash flow, profitability, if the books are always 6 to 12 months behind, or if the books are always a mess, if the banks are never reconciled and this and that. And so, understanding that the bookkeeping is the foundation of just the overall strategic planning in all contexts, right? Like tax planning, profitability, cash flow, and to take it seriously from day one, as opposed to like what happens. And it's not because people it's just because people are busy with life, and I totally get it. But it's just something that if business owners can understand on day one, it's not going to guarantee their success, but it's going to set themselves up for increasing their chance that much more of being successful, because their books are this management tool that they can use to make decisions to
100%.
See how
yeah. If you don't know your numbers, you're kind of shooting in the dark. And, I agree. And like I said, I've been there, right? I tried to do the QuickBooks for one of our LLCs for like a year and a half before I finally took my own advice that I give everyone I work with, which is, look, if you're starting a business, to your point, having accurate books that are up to date is hugely important. However, it is never going to be the best use of the business owner's time. Outsource it. Bring someone in that knows what the hell they're doing and has the time to do it. But to your point, like setting yourself up in the beginning, having that foundation, not only is it key to really running your business in a smart way going forward, but it's also just easier, right? If you set it up in the beginning before there's a whole lot happening and you get those systems in place, or your team or whoever's doing it, get that in place in the beginning. It's a lot easier and a lot less time consuming than like I had to bring in an accounting company. They spent, probably 3 months getting me caught up, right? That was not cheap to have them get me caught up. And now they handle it every month, right? And so we're up to date and it's no big deal. But if I would have just done that from the very beginning, it would have cost me less money and not been as much of a headache as it ended up being for me, to get the right systems and processes in place. So
But you figured it, at least you figured it out, and because a lot of business owners do, and so it's there are different factors that go into, there are different factors that go into play other than bookkeeping system as to why businesses fail and why businesses go on to scale and thrive. But a common denominator amongst businesses that fail, I bet dollars of donuts that a common reason why they fail is because they're not really taking their books that seriously. Yep. And a common denominator amongst businesses that thrive is that they're never, bumbling and stumbling about the books being 3 to 6 months behind and stuff like that. They know their numbers. So, and you brought up so many things Wes, what you just brought up right there, that was really important about, and another thing about business owners that, it's very important to know going into it. And if not going, learn it sooner than later is, working on the business versus working in the business, and progress, not perfection, and, trusting your team and not micromanaging, and to not get caught up, don't trip over dollars to save nickels, as they say. Mm-hmm. And it's not easy to do. I was a very technician dominant personality. And so that's a plug there for the E-Myth Revisited by Michael Gerber, where it's a great book. But so many of the E-Myth, the E-Myth as in the entrepreneur myth, so many, people think that business owners are entrepreneurs. And while we are, but what we really are, we also have, every business owner has inside him or her, the technician persona, the person actually doing the work, the manager persona, the person that's managing the people doing the work, and the entrepreneur, the visionary, the one creating the different revenue streams and opportunities. And so, another thing to avoid is to not get stuck in the mud on the little things. As do you own a business or do you own a job? Do you own a business or do you own a job? And there's a reason why so many businesses fail to sell, or they sell for much lower than the seller was anticipating. Yeah. Because many business owners out there, they own jobs, they don't own businesses. The seller is doing everything, and when they leave, who's going to do everything? Buyers want recurring revenue, they want standard operating procedures, they want key employees in place. Those are things that drive the multiple of a business resale. And so, do you own a business or do you own a job? And so if the business owner, if he or her are doing all the little micromanaging things every day and doing all the working in the business every day, and when you were saying you were doing your own books to a point, and then you just you brought in some other firm, because doing your it's one thing to understand how to run basic reports on your QuickBooks, and how to understand how to read an income statement, how to read a balance sheet. You want to know how to do those things when you're reviewing and having strategy sessions with your CPA, for example. But to actually do the bookkeeping, the day-to-day yourself, maybe you got to do it for the first 6 to 12 months while you're in startup. But that's one of the classic definitions of working in your business. And your time, your point, your time, Wes, as a business owner, my time as a business owner, is spent doing other stuff that's more high level, that's more business development, that's, surrounding, building the team and stuff like that. So
that no one else is going to be able to do, right? There's people out there that they specialize in putting data into QuickBooks and, running your financial reports every single month. So, makes total sense to me that that's a common mistake you see, is people not taking that piece seriously. And, you mentioned, building your business so that you can sell it. I've seen franchise owners that have been in business for 7, 8, 10 years get to a point where they're ready to sell, and they just come up with an asking price out of thin air. And, because I've worked for franchisors doing franchise sales, and I'd have, a franchise owner come to me and be like, "Hey, Wes, I want to sell my franchise. Do you think you can, help me find a buyer?" My first question became, okay, well, are your financial statements up to date? And what is your asking price? And where did you come up with that number? And all too often you would realize that the number was pulled out of thin air, and their books were 2 years out of date. And so it was I'm not even touching this until you get your house in order. Get your books caught up. Let's look at your numbers. Let's see where your business is. And then let's come up with a realistic asking price. Otherwise, there's a lot of people that are going to waste a lot of time if you're trying to sell a business with outdated books and you've pulled a number out of thin air. for your asking price. So that makes sense. Any other kind of common mistakes that you see people make outside of, not taking the bookkeeping piece as seriously as they should?
Yeah. So not taking the bookkeeping piece seriously, and just not taking the time to effectively communicate with their team. Okay. For bookkeeping and tax planning, and I'm a CPA, right? Vital part of any business. But in my opinion, the most important thing as a business owner is to create culture at your company where people like to work and you reduce turnover. And so just understanding that if you're in any sort of, you most likely have, if you're not a solopreneur, you most likely have an employee or a couple of employees or multiple employees, and just, taking the time to, communicate with them, get their feedback on things, get what makes them tick. Because not everyone, is motivated by money. Do people want to make more money? Of course, but people also want, to feel empowered at work. They want autonomy, title to them matters and stuff. And so just communicating with your team and putting in the time to do that is, you're going to as a business owner, just being accepting the reality that you're going to have to just hire, fire is just a normal thing of life, knowing that people are going to quit, people are going to have to get fired, but knowing that there are good people out there, and it's just a matter of finding them. And when you do find them, do what you can to, what I like to say, put golden handcuffs on them, right? Like they still may leave, but hey, you know what? Pay them. If you find some good people, pay them a little bit above market. Give them some nice benefits, give them profit sharing, just do what you can to reduce turnover, because in the macro, if you can create good culture and take care of your team, that's going to reduce turnover. And that is going to accelerate your growth, because when you all of a sudden, when a key employee leaves you, then, you most likely have to go in there and hold down the fort until you find someone else. And that's going to start your growth. And so it's just dealing with people. Being a business owner is it's in the relation, a relationship, just like you're in a relationship with your significant other, just like you have a relationship with people in your personal life, being a business, you're in the relationship business, if you have business partners, employees, customers, vendors, clients, et cetera. It's the relationship business, dealing with people. And if you have a tough time dealing with people and you want to be a business owner, you either got to switch it up, or you got to bring someone on board that is a great people person.
Definitely. Yeah. It's a great answer. I couldn't agree with you more. Any business where you're going to have people on your team, finding and keeping good people is going to be the single biggest challenge and the most important thing, that's going to have an impact on your success. So kind of, shifting gears a bit here, right? We talked about some of the biggest mistakes that you see people make when it comes to, their accounting, their tax strategies. What are some of the biggest tax incentives that you see people missing out on that they could have been taking advantage of, but they haven't been? You already gave us the example of, once your business is making money, if possible, set it up so that you're taxed as an S Corp, because you can save a significant amount of money through doing that. I'm curious if you have any other examples that are somewhat common. I'm thinking, vehicle write-offs, home off. I mean, these days, so many people are working from home offices and stuff. I mean, just what are a few examples off the top of your head where you look at it and you're like, oh yeah, you could have been writing this off, and people just have not been taking advantage of some of the incentives they could have?
Yeah, great question. So first of all, being a business owner, the Internal Revenue Code is written for the self-employed. There are so many benefits that you get from a tax perspective. Now there comes with more burden of record keeping, compared to being a strictly W-2 employee of a company that you don't work for, that you don't own. Yeah. But, you get there are a lot of things that you can write off pre-tax as a business owner, as a self-employed in the eyes of the IRS, that are not at your disposal if you're not self-employed. So if you're working from the home, then there is a home office deduction that of course, that's something that you always want to proceed with caution with, because people like to get aggressive with it. So that's always an exercise in, making sure that it's a legitimate amount. Yeah. I get asked all the time, hey, Mike, I work out of my kitchen. I work out of my like finished basement, and I, and it's like one of those things. It's just like
I sent an email from the bathroom. Can I write off the square footage of the bathroom too?
Yeah, exactly. Yeah. And so what the IRS will say, again, I'm just the messenger audience, so don't get mad at me. But the IRS will say the room it can't double as a personal room. So you have to have so if the IRS auditor, if you don't have it set up, if the IRS auditor were coming to your house in a week, you got to find that room that you could build the home office, and it's not, can't double as a personal room, like the kitchen, the living room and stuff. So home office, if you have a vehicle and you're using it for business use, to be able to break that vehicle down between business use and personal use, then absolutely you can write off the vehicle business use component of it.
Is tracking mileage, like if you have a vehicle that you use for both, is tracking mileage for business use the easiest or the best way to do that, or does it depend?
So you want to track mileage, you want to track mileage, and to get and that's a burdensome, thing to do. A lot of people don't want to do like the day-to-day of tracking it, but if you were to get audited, the IRS auditor is going to want to see the mileage log. And so there are two different ways to write off auto expense, right? There's mileage and there's actual expenses. And so, the mileage is broken down between business mileage, commuting mileage, and personal mileage. And so like a lot of people, once they, they realize, once they crunch the numbers, they realize that a lot of what they thought was business is actually commuting. So it actually is better off for them to take the actual. And so
what's the difference between business and commuting?
So great question. Commuting mileage is where you go to the first, when you leave the house in the morning to the first place of business that you go, that's commuting. And then all the places that you go in between are business. And where you are at the end of the day to back home is commuting.
Even if you own the business?
Even if,
Huh. Okay. Yeah. I never.
And I get asked all the time, hey, Mike, I work out of the house now. So when I roll out of bed and I walk from my bedroom to my office in the house, is that my commute? And again, it's I think that's a great, I say personally, Mike, the individual is I think that's a commute. Makes sense for me. But again, the IRS will say,
IRS doesn't agree.
Right. The IRS, is ruining the party a lot of the times. But
wow, that's what they do. That's their MO.
Though. Sorry, Wes, go ahead.
No, I would say that's the IRS's MO is to take all the fun out of it, right?
Right, exactly. But I think that the actual expense method is a lot of times more beneficial, because if you have a vehicle, you can take the business use of the purchase price of the vehicle, whatever the business use percentage is. Take the there are lots of vehicles that are being used 100% for business. If you have some sort of service business, and you may have a van that's strictly that's wrapped in the franchisor's logo, and that's 100% for business. And so there's bonus depreciation on the vehicle. You can really get a nice rate. If you're leasing the vehicle, you can write off the lease payments as an expense. So I prefer to go actual expense more than mileage. Mileage is more, is usually better for that sole proprietor, traveling salesman, the one that's really traveling everywhere all the time and stuff. And they have a lot of business miles compared to commuting miles and stuff. But for the most part, for most businesses, we're in agreement that, it's more beneficial to go the actual expense method compared to the mileage. But there's let's talk about some other stuff, right? So retirement plan, self-employed retirement plans. You can put a lot, if you're making all this money and you've written off the home office, you've written off the vehicle, you've written off this, you've written off that, you still got this profit, you could, whether it is a 401k or a SEP or a simple or a pension plan, like a cash balance plan, a defined benefit plan, you can put if you have a self-employed retirement plan, you have a lot more maximum contribution flexibility to put away and just shovel away massive amounts into your retirement plan each year, just to bring your taxes down by making massive retirement plan contributions. I have so many service professionals that make a lot of money, and they just they write off the home office, they write off the vehicle, they write off all the things that they would write off, and they're still staring down this giant profit. And their free cash flow, their cost of living, their free cash flow allows them to just put a huge chunk. And that's what into the retirement. And that's what I was getting back to for S Corporation, what we were touching on earlier, is the savings and self-employment taxes that's like very strategic when you're operating with a profit between like 50,000 and like a couple 100,000. And then, but then anything over and above that, it's like, okay, well, I got to take this amount of salary anyways, and I'm already going to be maxed out on my Social Security anyways. Let me take more salary. And I know I'm going to be getting hit with that extra self-employment tax, but by taking more of that salary, it's going to allow me to make a bigger retirement plan contribution. And so, yeah, I know self-employment tax is 15.3%, and I'm getting dinged on the 15.3%.
But it caps.
That's allowing me to put $1 into my retirement plan and sheltering it from income tax, federal and state, depending on what state you're in. That can be between 30 and 40%. So like a retirement plan. Another thing about being a business owner is there's a legitimate, like as I like to say, like, the legitimate family business, right? Like not the mafia, right? But like the legitimate family business. Like so many business owners can justify that their spouse is helping out with some sort of like admin or marketing capacity for the business, and they can justify giving the spouse like a $15,000 or $30,000 salary, if not more. And then teenage kids. Like, I mean, I know I was working at like age 13. And so like you can justify, and I guarantee you that kids these days, that are 15, 16 years old, they know more about the social media marketing landscape than their 40, 50, 60-year-old parents.
Sure.
And so like, you can justify putting your kids you can justify your kid doing some sort of admin or marketing, and then so now, you could, if you put your spouse on the payroll, justifiably, then now you have an extra head to make an extra 401k contribution. Now you can double up your 401k instead of putting away $20,500 for just you. If you're under age 50, now you can do it for your spouse too. That between the two of you, that's 41k. And then if your kid is taking a salary, now you give your kid justifiably a salary of like a part-time employee doing marketing admin stuff of $15,000. Now you're getting $15,000 that's reducing your income, picking it up on your kids' taxes where they're only being subject to tax of like 0 or 10%. And so, you could even set up, you can set up an IRA. Now you can put away some money in their IRA for them. They get some earned income. So the legitimate family business is something that opens up to you as a business owner that, a lot of people are not fully taking advantage of that they could because they're a business owner. As opposed to like working their corporate job. You can't tell your corporate boss, like, hey, can I give my $200,000 salary? Can I give like 50K of it to my kid? They're going to be like, what are you doing? You're fired.
Yeah, no doubt. It's such a good point. And those are all great examples, of where, as you're sitting there laying out some of these examples, like, we're probably not capitalizing on some of these the way that we should. Now, my oldest kid just turned 5, so that maybe that's in a gray area. I don't know. Maybe we could justifiably.
So the gray area there is, could you like have your 5-year-old like dress up and like be part of like a photo shoot that's like used as like marketing?
She's
material?
done it. Yeah, she's done it. She's come and hung out at home shows. She's put out door hangers. She carries
gray
stuff
area.
around. So it's a gray area, right?
That's more gray area than it is black and white. Like that's not black and white. Oh, no, 5 years old, can't do it. Like if they're like, and you've got the, like she's done it before, you can, they're like, to just make sure that all the documents, all the I's dotted, T's are crossed, it can back up. I see justification.
Yeah. Interesting. So yeah, there's so many. And again, it all comes back to, don't try to figure this all out yourself. As you can hear Michael talking, this is complicated stuff. He spent so many years learning, all of this inside and out so that he can advise his clients. We've already talked about it, right? As you're a business owner, especially if you're just starting your business, you're wearing a lot of hats. You got a ton of things. You're not going to have time to sit down and, do all the studying that it takes to become as knowledgeable as a CPA. So don't try to figure it all out yourself, and definitely don't put your head in the sand. And I think a lot of business owners do that. They just say, I don't understand it. It's complicated. I'm busy. I'll get to it at some point. Right. And they just put their head in the sand, and the consequences can be dire in some cases, right? It probably is a reason, or at least a component of why a lot of businesses ultimately don't make it, right? And that leads me into another thing I wanted to ask you about, right? what advice do you have for business owners when it comes to being more proactive about preparing for paying their taxes? And I'll give you a little context, right? I can remember the first year that our household was completely, all of our income was income from our businesses, right? We had no W-2 income whatsoever into the house. And I remember getting a call from our CPA, and he works with a lot of business owners, a lot of people that have businesses much larger than us. I can just remember like how casual he was about it, but he was like, yeah, it looks like you're gonna need to give me a check for about $60,000. And he was just super casual. And I can remember being like, holy I got to write a check for $60,000 for taxes. Right. Like we had the money, but I wasn't like prepared for it. Right. I don't know what I was expecting. Now that I think back to it, I don't know was I expecting like 20? I was probably expecting like half of that. Right. And I didn't know. I wasn't prepared. I wasn't thinking strategically. I wasn't having these types of conversations with him. Like, hey, based on what you're seeing, what do you think our taxes are going to look like next year? What can we do to prepare for it? We had the money, but I also had plans for, a good chunk of that money that ended up going to pay the tax bill for that year. So, what advice would you have for small business owners to not find themselves in that situation? Because I can imagine there's plenty of business owners that get that same call from their CPA and they don't have the money to pay it. Right. And then there's interest and you get on the, blacklist for the IRS, and none of that is good.
No, it's not. It goes back to first of all, a big part of my reply is, it goes back to bookkeeping, right? Like your bookkeeping should be something that's being perpetually updated throughout the year. So come January, February, your books are already ready for they're already updated from the prior year. So that's not going to be an issue for filing last year. It's I got to file taxes. It's oh, my bookkeeping is not even done for the prior year. So now you're spending the next 2 or 3 months scrambling. You don't even know, you have no idea. Right. So bookkeeping so having your books perpetually updated throughout the year. So come January, February, it's okay, I already know where my numbers are. I'm looking at a profit of X, Y, or Z. So for business, the first quarter of each year, and then an argument can be made just January, February. And really that's only just because the IRS doesn't start really a bit Feb. But at the very most, 3 months out of the year in Q1, if not 1 or 2 months, should be focused on getting last year's taxes filed. The dialogue between the client and their CPA, any sort of dialogue, any sort of annual, the amount of time that the planning for the current year and subsequent year, because in that 75%, if not 85% of that dialogue is centered on current year. Then come January, February of next year, you already know what your tax is going to be. You've already planned for it. Throughout the year, you've done what you could do to bring it from here down to here, and so you're expecting it to be here. There are certain things that you can only do while you're in the year, as opposed to what you're only doing so much once the December 31st is already passed. So if the dialogue with your CPA is, if you were to as a business owner, if you were to if there was some way that you can measure all the conversations that you've had with your CPA in the current year, all right, how much of that was focused on talking about last year's taxes versus how much of it was current year and subsequent year planning, having that be no less than 75-25. Not even 70-30. It's because that means that if it's 75% trying to get last year's filed and 25% or 0% talking about current year, then it's always going to be a surprise each year. It's always, you're going to be in summer of 2022 finding out for the first time, sticker shock, you owe $60K on 2021's taxes. That's always going to be the case if you cannot get your bookkeeping right. And so just the majority, and that's why I always tell people, it's the services that my firm provides, we are, there's the compliance and maintenance services like tax prep and bookkeeping, sales tax, payroll, and that's, one service. But it's the advisory services. It's the advisory services, the CFO services, the family office services, the advanced tax planning. Those services are inherently more valuable than any sort of fee to file taxes, because the type of stuff that we're having planning in these advisory conversations are resulting in strategies being implemented that are saving the client, thousands of dollars, sometimes less, sometimes more, but that valuable advisory is what it's all about. And so that has to be happening for 75% or more of the time that you're talking to your CPA throughout the year.
Yeah. Great answer. I like that. And it makes a lot of sense. Do you have a preference or a recommendation? Should you file for an extension, not file for an extension? Doesn't really matter. What's your advice, or is it really doesn't make a difference?
I think that if all goes according to plan, for that everything is proactively being done throughout the year, there shouldn't be a need to file for an extension. The only time where there might be a need to file an extension, so if you have a profit sharing contribution to the retirement plan could be made the subsequent year, as long as it's made before the tax return for the business is filed.
Right.
So depending on the current year cash flow, if cash flow is tight, maybe you have to file an extension for your S Corp partnership on March 15th to get you to September 15th, because you're going to have a lot of cash flow coming this summer, and you can use that summer cash flow to fund the profit sharing for last year. So that's an example of why you may want to go on extension. But and the other reason to go on extension for the most part is usually because, we just can't get around to it. And if we can't get around to it, again, and that's still happening,
Yeah.
But if every, for every, in the spirit of everything that we just talked about, if everything's going according to plan, there shouldn't be a need to go on extension. And if you're going to go on extension, that's fine, but just at least, pay something in come extension time, because an extension is only for time to file. It's not for pay. If you file an extension and you file your taxes in August and you owe a balance due, then you're going to, not only going to owe the tax, but then interest and late payment penalty are accruing since April 15th. What you avoid by filing an extension is the failure to file penalty, which is the most severe penalty, but it doesn't negate interest and failure to pay penalty.
Right. Yeah. So we typically file for an extension, and it's just a result of us not being prepared, back in year one when we first had to file taxes as a business owner. Yeah. And our CPA is always, giving us at least a ballpark amount, hey, go ahead and write a check for this amount. And then once everything's kind of filed, then we will, settle up, right? If you end up owing a little bit more or whatever, but he's you don't want, all this interest and late fees piling up.
There's different schools of, I don't mean to cut you off, but there's different schools of thought on it, right? Because, I understand the other school of thought, which I respect, and I totally get it. It's just and then there's the school of thought, well, does this increase your audit risk? It's you can always get audited for any reason, randomly, even if you're doing everything right. But there's also the school of thought of hey, you know what? I know that I'm going to owe 50 grand. I know that there's going to be some penalty tacked onto that, interest tacked onto that. But man, do I hate paying the government. So I know I'm going to get tagged with it, but I'm just going to pay it in October. And I know I filed for my extension, so I avoided the late filing penalty. But I know that there's going to be late payment penalty and interest tacked onto it. But I'm using that money. Yeah, I'm using that money for the first 10 months of the year doing other stuff. And I budgeted. I can pull off of a line of credit or whatever to pay it. I've got that money. I know I'm going to be dinged on it. But man, I hate paying the government. They're going to pay for that. Well, so I respect that school of thought, and there are a lot of people out there. And what you said, Wes, is really important. You got hit with the $60K, and you weren't expecting it.
Yeah.
If you're expecting it, and you're
you know what, I'm
expecting that it's going to get tacked on with a little interest. It may be instead of $60K, maybe it's $63K. Right. But I'm ready for it in October. Then. As long as it's no surprises, regardless of when you pay it.
Exactly. I mean, we've done what you were saying before. I'm trying to remember one year we filed an extension. I think I went ahead and paid something for state maybe. and then just let the interest for federal go. Because I think, if I'm remembering correctly, state, the interest was a lot higher than federal, maybe, at least where we are in North Carolina.
State, yeah,
we're in North Carolina. So I think, our CPA had said, look, you want to go ahead and pay, what you think you're going to owe for state, because the interest can really add up on that. He's like, the federal, difference of a couple $1,000. And I was like, looking at it, I got 10 months. I got some things I want to do with this money. I'm also looking at my cash flow, knowing that, I've got a lot of cash flow that's going to come in between now and the next 10 months. Yeah, I'll eat the interest and hold on to this money for now, knowing that I can put it to work and I'm going to be in a much stronger cash position come October or whatever. But, the point is, I like the way you said it. No surprises. Be having these strategic conversations with your CPA. If you're spending all your time, talking to your CPA, just trying to get caught up, then, you've got no hope at being strategic or proactive going forward. Man, this is good stuff. Cause I mean, a lot of these are questions I've personally had or have had, or, issues that I've run into. I know these are questions that are top of mind for other people that are out there considering getting into business for themselves. And, Michael, you're just a wealth of information. There's so much more. We'll have to have you on for round 2 at some point, because there's so much more that we could get into and unpack and just kind of learn from your expertise. I want to make sure that you have a chance to tell people, where they can connect with you, where they can learn more about your firm. You've been fantastic, folks that I work with that are exploring franchise opportunities. You've always been, happy to do free consultations with them, answer questions, give them, some advice on what business entity is going to make the most sense, et cetera. Like we talked about, given their circumstances. So where can people connect with you? Where can they learn more about your services? And if they did want to, reach out and set up a consultation, how could they go about doing that?
Absolutely, Wes. Thank you. I want to give a plug into Wes's video editing team, because we might need him right here. So you could, visit my company's website right here, swartzreeder.com.
We'll put it in the notes for sure.
Yeah, you can check me out on LinkedIn. My LinkedIn profile right here, Michael Ian Reeder on LinkedIn. Send me a connection request. You can call me on my cell phone. You can call or text me on my, so you got my office number right here, 847-241-5800. We got my cell phone, 847-302-3397. You can text me there as well. You'll see on our website, there's a way that you can schedule a Calendly. We just started our YouTube channel, so that's going to be happening soon. There'll be a lot of content on the YouTube channel coming up.
Nice.
So yeah, there are, send me an email. Go to my website. My email is michaelreeder@swartzreeder.com. And so email, phone, website, LinkedIn, just reach out to me. I'm here to be of service to all of you. Would love to, schedule. I'm all about the consultation calls, the intro complimentary consultation calls. Really, like, especially if you're buying a business out there and you're working with, a great franchise consultant like Wes Barefoot, one of the best in the business. Wes, everyone that you refer to me, they just speak so highly of you. And so it's just so great to see, someone like you in the franchise industry doing things right. There are a lot of bad actors. And there's a lot of, things going on, not only in this industry, but you're one of the good ones, Wes. And so I'm really grateful to have you in my network. And so, but if you're a business buyer working with someone like a Wes Barefoot, if you're a business buyer and you're not working with a franchise consultant, number one, give Wes Barefoot a call. Okay. And then when it comes to anything, entity structure, funding strategy, I am here to provide value to you. So reach out to me. So I'm here. Let's do it. And, freedom, right? I mean, like the name of this podcast is Path to Freedom. And to me, this is my humble opinion. I think that a big part of being, free, number one, I'm grateful to live in this country, best country on the face of the earth, no matter what anyone says. And being a business owner, it comes with its challenges, but I personally, this is the lifestyle for me. I work hard, but the autonomy So for me, I like making money just like the rest of us, but I have the flexibility. I went to Europe to visit my in-laws for 4.5 months, earlier back in 2021. And that's just one example of just like being a business owner to me, because if you're a corporate employee, if you're doing this or that, you can get laid off at any second. You could, you are running around making that corporation so much money for the big wigs, and you're doing all the work and you're getting paid crumbs. And so for me, being a business owner is, a big part of being free. And so, I can't guarantee, just like Wes can't guarantee your success, but, being surrounded by people like Wes and myself can increase your chance of being successful in business. And that's what it's all about. So I would love to connect with you all, and thank you, Wes, for having me on.
Hey, my pleasure, man. Thanks a lot. I know everyone listening is going to get a ton of value. I learned a lot just in this conversation. I learned something new every time I talk to you. So really appreciate what you do. Thanks for making time to drop in here on the Path to Freedom podcast. Everyone go connect with Michael. Check out his new YouTube channel. We'll post all your contact info, website, all that good stuff will be in the show notes to make it easy for people to find you. But appreciate what you're doing. Keep helping small business owners everywhere. Make sure they're not getting in trouble with the tax man, and thinking strategically. And appreciate everything you've done for me and the folks that I've connected you with. But we'll have you back on so we can do this again. Thanks so much, Michael. Appreciate it. Thanks everyone for dropping in to another episode here on the Path to Freedom podcast.